Imagine opening your mailbox and finding a tax bill for $60,000. Money you don't have, money you've never touched, money sitting locked inside a trust you can't access for 5 years. That is exactly what happened to one person who recently inherited their late father's estate. And the worst part, according to the IRS, they owe every single penny of that tax right now. Today we're breaking down how this nightmare scenario happens, why the tax law works the way it does, and most importantly, what you can do if you find yourself in a similar situation. Let's set the scene. When someone passes away, their assets don't just magically transfer to the people they loved. There's a process. Sometimes it's simple, sometimes it's extraordinarily complicated, and when significant money is involved, we're talking hundreds of thousands of dollars, the legal and financial machinery that kicks into gear can take years to fully unwind. In this particular case, the person's father had passed away and left behind an estate that was still in the process of being settled. As part of that estate, income was being generated, investment income, dividends, perhaps interest or rental income, and that income was documented on a form most people have never heard of, the K-1. Now, a K-1 is not something you'd get from a regular job. You won't see it if you're just earning a salary and getting a W-2. The K-1 is a specialized tax form used to report income that flows through what the IRS calls a pass-through entity. Things like partnerships, S-corporations, and yes, estates and trusts. The form shows up in your mailbox, it tells you how much income has been allocated to you, and here's the kicker. The IRS expects you to pay tax on that income, whether or not you've actually received the cash. That's the part that shocked this individual to their core. The K-1 showed roughly $300,000 of distributed income flowing to them from their father's estate. At their tax rate, that translated into approximately $60,000 owed to the federal government. $60,000. And they had none of it. So how did we get here? Let's walk through what actually happened, because this story has layers that a lot of people don't fully understand until they're standing right in the middle of it. When someone dies, their estate becomes what's called a legal entity for tax purposes. While that estate is being administered, meaning while the executor is paying off debts, distributing assets, and going through the probate process, it can continue to generate income. Maybe the deceased owned stocks that paid dividends. Maybe they had rental properties still collecting rent. Maybe they had investments in partnerships or funds that kept producing returns. All of that income has to be reported somewhere, and the IRS requires that it be reported on what's called a Form 1041, which is the income tax return for estates and trusts. Now here's where it gets really important. An estate has a choice to make. It can either pay the income tax itself at the estate level, and estate tax rates can be brutal, reaching the highest federal bracket very quickly, or it can distribute that income to the beneficiaries and pass the tax obligation along with it. When an estate distributes income to a beneficiary, it issues a K-1 to that beneficiary, essentially telling them, here's your share of the income, you're responsible for reporting it on your personal tax return. In this person's case, the estate had distributed income, $300,000 worth, and issued them a K-1. The problem is that the word distributed in tax language does not necessarily mean the cash landed in their bank account. It means the estate allocated that income to them for tax purposes. The actual cash could still be sitting in a trust, locked away, inaccessible, and yet the tax is still due. The IRS doesn't wait for you to actually hold the money in your hands. The legal allocation of the income is enough to trigger the tax liability. This is where this person found themselves completely blindsided. They're grieving. They're dealing with the emotional weight of losing their father. They've never filed complex taxes before. They do everything right. They work with a tax preparer, they file on time, and they get hit with a $60,000 bill for money they literally cannot access for at least 5 more years. So what are the options? What can someone actually do in this situation? First and most importantly, this person needs to go back and have a very serious conversation with the estate's attorney and the trustee, the person or institution responsible for managing the trust. Because here's a question that needs to be answered. Was this income actually distributed to them in a meaningful way, or was it simply allocated on paper? There's a legal and accounting distinction here that could matter enormously. If the trust or estate documentation makes clear that the beneficiary has no right to access the funds for 5 years, there may be grounds to argue that the income was not properly distributable to them in the current tax year. Second, they should consult a tax professional who specializes specifically in estate and trust taxation, not just a general tax preparer. This is a niche area of tax law with its own set of rules, exceptions, and strategies. An estate and trust tax specialist might find issues with how the K-1 was prepared, whether the income was allocated correctly, or whether there are deductions or credits that weren't fully captured. Third, if the tax bill is legitimate and unavoidable, the IRS does have payment options. You can request an installment agreement, which allows you to pay what you owe over time in monthly payments. You can also sometimes request currently not collectible status if you can demonstrate genuine financial hardship, meaning you have no ability to pay right now without causing serious economic harm. Neither of these options makes the tax go away, but they can prevent the IRS from coming after you with enforced collection actions like liens or levies while you work through the situation. Fourth, and this is a longer-term conversation, if the trust is structured in a way that's creating ongoing tax problems for the beneficiary without giving them the resources to pay those taxes, that might be something that can be addressed through a legal modification of the trust terms. This isn't always possible, and it depends heavily on how the trust was written and what state law allows. But in some cases, courts will approve modifications to a trust when the original terms are creating an undue hardship. There's also a broader lesson here for anyone who is either a beneficiary of an estate or involved in estate planning for their own family. The structure of how assets are left to loved ones matters enormously from a tax perspective. A well-drafted estate plan takes into account the tax consequences not just at the estate level, but at the beneficiary level. Trusts can be incredibly powerful tools for protecting assets and ensuring they're passed to the right people at the right time. But they can also create situations like this one, where someone inherits an obligation without inheriting the means to fulfill it. If you know you're going to receive a K-1 from an estate or trust, there are things you can do to prepare. First, find out early. Don't wait for the form to arrive in the mail. Ask the executor or trustee what income the estate generated during the year and what your share is expected to be. Second, set money aside. If you have any cash available from the estate or from your own savings, set aside funds to cover potential taxes before you spend anything else. Third, consider making estimated quarterly tax payments to the IRS once you know income is flowing to you. This can help you avoid underpayment penalties on top of the actual tax you owe. And if you're on the other end of this equation, if you're doing your own estate planning right now, please talk to an estate attorney about the tax implications of the trusts you're setting up. Consider whether a trust should be structured to pay its own taxes, rather than passing that obligation to beneficiaries who may not have the liquidity to handle it. These conversations feel morbid, and nobody wants to have them, but they can save your loved ones from being blindsided by a $60,000 tax bill while they're still grieving your loss. The person at the center of this story was in a genuinely difficult spot, not because they did anything wrong, not because they were careless or reckless with their finances, but because the tax code operates in ways that aren't intuitive, and the estate was structured in a way that created a real mismatch between taxable income and accessible cash. That kind of situation is more common than people realize, and it can happen to anyone who inherits assets through a trust or estate. If this happened to you, if you've received a K-1 from an estate or trust, and you're staring at a tax bill you don't know how to pay, the most important thing you can do right now is not panic, not ignore it, and not try to handle it alone. Get a qualified tax professional with estate and trust experience on the phone today. The IRS has more flexibility than most people realize, but only if you engage with them proactively. If you found this video helpful, please subscribe so you never miss a breakdown like this one. We cover real tax situations that real people face every single day. And our goal is to make sure you're never caught off guard.